You've been away all year long. It's been an eventful year for the automakers, including what we just heard this afternoon from President Trump. GM is not going to be treated well. How much pain can the government inflict on GM?
Well, the government can have points of view and they can make some lives difficult. But at the end of the day, I think what Mary Barra and the GM team did was basically look at their business and understand, listen, they need to get their cost structure in line because, the business is coming to the end of a cycle and they have lots of challenges going forward. So they did what's right for the business, and every CEO needs to do what's right for their stakeholders, including shareholders, et cetera. So they're going to have to work their way through it. Anytime you close a plant or idle a plant around the world, you're going to get attention from the government because it's so important to the economy and jobs.
But I remember reading that you, in preparation for President Trump as the head of Ford, read Art of the Deal. So would you have handled this whole situation differently if you were still in charge?
Well, it's easy to sit on the sidelines and have opinions, but I think at the end of the day, when you take these kind of actions, you need to make sure that you're doing it in a way that allows you to tell what the story is, and at the same time, make sure you have a narrative around why it's good for the business over the medium to long term, while you have to take these short-term painful actions.
So as we mentioned, we haven't heard from you since you left the company. There have been so many stories. You left abruptly, missed opportunities, so on and so forth. Now you have a chance to set the record straight. Is there anything you wanted to say about the departure?
No, not really. Listen, at the end of the day, I spent over 30 years at Ford. There's terrific people at Ford. The board, during my tenure, we had record profits, record margins. We had laid a strategy out for the future, but the board decided to go in a different direction, and I decided to retire.
Any regrets on the shift from cars to SUVs and the speed at which that happened, or the shift to autonomous and electric vehicles and the speed at which you moved the company?
Well, we were moving in that direction, and as I said, during that time period, the financial performance of the company was very good. And what the team is dealing with now is trying to define that future, define what that transition is. And it's going to be a challenge for the entire industry because you're coming to the point now where the cycle is ending, so volumes are starting to fall off. Interest rates are up, so you can't use incentives, whether it's extended loan maturities or higher incentives, higher leasing, to keep volume going. But then there's two new unique things that the industry has never had to face before going into a cycle. One is they have to keep investing in electrification and autonomy. And secondly, when they introduce these electrified vehicles, they're going to be at a lower margin than internal combustion engines. And it'll take probably 5 to 7 years for cost competitiveness between a battery-powered car and an internal combustion engine car. So they're going to have to deal with that environment, which brings it back to every CEO across the globe is making sure that they're working on their cost structure.
How far ahead is Tesla's Elon Musk on that front?
On the, which front?
Shifting to electric.
Well, listen, what Elon has done is he has really pushed the industry to embrace electrification. When you drive an electrified vehicle, it's a fantastic experience, great power and torque. The challenge there is how do you make money at it? And Elon's challenge this next year is how does he and his team balance rolling out cheaper models of the Model 3 to boost sales, but at the same time not sacrificing that commitment to attain sustainable profitability. That will be the challenge for him and his team.
I was talking to Phil LeBeau earlier, whom you know very well, and he has this great graphic actually of the stock performance of Ford under various CEOs, and it hasn't done much better under your predecessor since you left. I think the stock is down 20%. So do you feel vindicated by that?
I don't look back. I think at the end of the day, Ford down in the ranks, they have a great team. They'll figure it out. And, the market changes over time. And like I said, when I was CEO, yes, the stock price was down. I mean, it was very clear. The financials were terrific. The stock price was down. And I think this is going to be a long game that every OEM is going to be playing as you make this transition to autonomous and electrified vehicles. But at the same time, there's still going to be a large portion of internal combustion engines. This is going to take a long time, and it's going to take longer than people expect.
A lot of people look at the automakers and we're wondering where this industry is headed and what the move lower in the stock says about the overall economy or whether it's a specific problem related to Detroit and the auto industry.
Well, I think, I have a good perspective now because with my work with TPG, I'm on the boards of a number of different companies in different sectors. I work with also with a family office in Florida, a company called Amzac Capital, which is an outstanding organization. And I think what this says is, from our standpoint, from what I see, the economy is on strong footing, but it's starting to show these mixed signals. Right? On the positive side, you have wage growth, you have wage and income growth, you have employment growth. Unemployment is at a half-century low. You have consumer confidence very high. But you're looking at these flashing red signals around the housing market's down for 6 months. You have interest rates going up. But again, keep in mind, interest rates is reflective of a strong economy. But you also have business investment data softening. So you look at those things, and it does say, we need to prepare for the future, because at some point, the cycle's going to turn.
I think that's what the market's grappling with right now. And then you have the trade war. How hard has the auto industry been hit as a result of the tariffs back and forth?
Well, obviously, it hurts from a financial standpoint because of the tariffs, but more importantly, it hurts from a planning standpoint. Because, as you know, what businesses like the most, and particularly automotive, is certainty. Because the automotive companies have put their manufacturing footprint around the globe together based on trade agreements. And when those are in a state of flux, as you're investing in the next product program, and you're wondering where you're going to put that product and where you're going to source the parts, you have to understand, well, what's my assumption of the tariff environment around that gets back to the business case, and can you make money on that product? That, I think, is the real impact on, it's that uncertainty from a planning standpoint that has really impacted.
But are you supportive of the president's actual goals here? I mean, the auto industry has a long time wanted to revise trade agreements and wanted a more fair playing field anyway.
Well, I agree with what he's doing. What he is doing is he's addressing some long-standing issues around trade agreements, which have been in place many, many years. And like anything else, trade agreements need to reflect the times that they're in. And so I think he's working on exactly the right things. We can debate, how he's going about that. But in terms of the actual,
you think he'll succeed?
He's already had some success as the North American MCA, new NAFTA has been negotiated. And I think at the end of the day, it will succeed, but it'll be a lot of whitewater in the interim.